Happy New Year and welcome to the Real News Network. I'm Sharmini Pires coming to you from Baltimore. On Monday, one of the major stock markets in China, mainly the Shanghai market, plunged 7%, ending trading for the rest of the day and sending global stock markets into a decline. According to trade rules introduced last month in China, a 7 percentage point drop triggers an automatic suspension of trading. The effects of the market decline have been felt in markets around the world, with the Dow Jones plummeting over 450 points and stock markets of major corporations like Microsoft, Apple, Netflix, Goldman Sachs seeing considerable percentage point declines. Joining us now from Baltimore, Maryland to discuss this is Ho-fung Hung. He's the author of The China Boom, Why China Will Not Rule the World. He's an associate professor of sociology at Johns Hopkins University. So good to have you with us.
Hi, thanks. You're very
And,
welcome.
so let's just begin with what caused this stock market crash thus far.
The stock market crash yesterday is actually a continuation of the crash in the summer. Because in the summer there was a huge bursting of the stock bubble, and the Chinese government resorted to some extreme method to arrest the free fall of the stock market. And one of the extreme method is to the government issue an edict and telling all these major big state-owned companies executive cannot sell the stocks of their own company. So it prevents some big players in the market from selling their stocks, that they can only hold onto the stock without selling it. So it is one of the measures that help stabilize the stock market in the fall. And the Chinese stock market has risen up a little bit, moved back to stability in the fall. But that edict of not allowing state-owned company executives to sell their stock of their own company actually expired yesterday. So
So,
expectedly, that once the edict expired, that the people will be rushing to sell their stocks when before it is too late, when the market is still stable, of course, and it caused to a little bit of a stampede. Actually, many people already expected it. So this the one-day stock market plunge yesterday is a kind of a continuation of the stock market collapse in the summer.
now, this practice of buying your own stock or buying each other's stock by corporations is something that's practiced here. In fact, I just did an interview with some economists in the UK, and this is a problem there. Why is it a problem, and why did the Chinese government introduce this restriction?
Because that a lot of the stock market bubble that actually the Chinese government and many state-owned enterprise helped fanning since the fall of 2014 and spring of 2015, that the Chinese economy, the real economy, manufacturing expansion, real estate construction, and infrastructure construction, it has been slowing down for a while, since at least 2012, 2013. And many companies, particularly the big state-owned enterprise, are heavily indebted. So they are on the verge of getting underwater. In the fall of 2014, the Chinese government and many big players among the state-owned enterprises, they seems to risk take the risk of creating a stock market bubble, and imagine that rising stock market can help them become afloat again, because when the stock market rise, they can sell the stock of that they have been holding for their own company or each other companies, so that they can come up with cash to service or repay the debt. So it is the plan to create a stock market bubble that help to alleviate the debt problem of many local government and state-owned enterprises. And of course, and it didn't uh, end up very well. And as many people expected, that this kind of stock market bubble without and underlying strength in the economy is destined to crash, and it did crash in the summer. So when it crashed in the summer, many state-owned enterprise who has been selling and buying stocks of their own company and each other company become a culprit, and the Chinese government doesn't want to look back because the political legitimacy of the government has been so much dependent on the economic performance, and one of the key economic performance is the stock market. So the Chinese government resort to this extreme method to stopping the executive of the big state-owned enterprise from selling their own stock and each other stocks, and it worked a little bit, but it cannot last forever because people will scream if they stop them from selling their own stock forever. So it that has to have an expiration day, and when the expiration day come as yesterday, then it create a bigger problem.
Now, Professor Hung, if this kind of restriction that the Chinese government is placing on their markets is having this impact there, will this also impact the global market? And how is the global market responding right now to this crash?
That this crash definitely contribute to the fall in the Dow Jones today and in the stock market in all over Asia and Europe. But this kind of effect is more or less short term. But more worrying and the long term effect of Chinese economy on the world economy is that the 2008 U.S. witnessed the crash of itself, and then the global financial crisis hit many places, and China became um, you can say even a lone engine that to provide demands and hopes for many other economies through China's own stimulus uh, program that they rolled out in 2009, 2010, that basically they opened the floodgate of bank lending to local government and state-owned enterprises to build things, high-speed railroads, new airport, steel mill, and they don't care about whether these kind of things are going to be profitable, but they just build it and then create a economic bubble, a debt bubble as well, because many of these constructions are financed by lax lending of Chinese banks, but it pushed up the GDP and then pushed up China demand for raw materials from around the world. So you see that Brazil has been doing very well and untouched by the U.S. economic crisis back in 2008. And then in 2009, 2010, 2011, 2012, this China rebound create kind of uh, uh, effect to elevate the economy of Latin America and Africa, Australia, Canada, which export a lot of raw materials to China to fill the China debt financed construction spree. So it has been the kind of a key engine that prevent a total collapse of the world economy when the U.S. economy was in trouble and Europe was in actually because of the eurozone crisis was in bigger trouble. Now the European economy was still in a kind of a dismal state. It has not fully recovered from the eurozone crisis, and the U.S. economy is kind of recovering, but not strongly, and it is still a kind of a feeble recovery that even the Fed are not quite sure whether it can aggressively increase interest rates faster. So it is kind of a weak recovery in the U.S. and Europe is still in trouble. And then China was entering into a long slowdown since 2000, at least 2012, 2013. So it instantly create problem for all these raw material exporter. Like Brazil was in big trouble, its economy, South
Right.
Africa, Zambia, all other kind of African economy, and many U.S. companies like Apple, Caterpillar, uh, and GM that has a strong presence in China, and then also hit by the decline or slowdown of the expansion of the Chinese market. So it is going to be creating a global headwind for
Now,
everybody.
could it be considered that stopping or restricting the reacquisition of your own stock really helps stimulate the local economy in the sense that it forces people to actually take their money and invest it in industry and production instead of finance? Is this not a good measure, and should other economies adopt this policy?
It's not particularly a good measure because you cannot stop people from selling stocks of its own company and whatever forever. Because if you want to have a stock market, you need to have a kind of a freedom of selling and buying. If you try to adjust the market and then help the market by this kind of executive administrative measure, high-handed administrative measure, then it is no longer a market. And then if it is people find that they might have trouble selling the stocks when the stock is going down, and then it will actually prevent and discourage people from buying stocks in the long run. So this measure can only be a kind of a short-term uh, measure out of a panic, and in the long run, it is going to hurt the market because if you people expect that if the market is not doing well enough, if the market is going down, that I need to sell my stock. There is a possibility that the government will stop me from selling my stock when I need to cash in, then it will definitely discourage me from buying stock in the future. So this is not the way to go. And of course, it is only one measure that the Chinese government adopted in the summer. There are many other measures, executive and high-handed measure that the Chinese government did in the summer. For example, they are trying to stop people from short selling stocks as well. They are trying to uh, claim to investigate into people who are selling or short selling stocks and with some criminal charges. And at some point, they even sent police to take over some of the documents from the regulatory bodies of the stock market in China. So it is all these kind of measures are short term, and it showed that the Chinese government at that time, back in August, was in the panic mode. And it arrested free fall of the stock market for a while. But as I said, that in the long run, you cannot uh, resist the market force. And then this kind of executive high-hand measure to rescue the market can only create more trouble in the long run.
All right, Professor Ho-fung Hung, thank you so much for joining us today.
Thank you for having me.
And thank you for joining us on the Real News Network.